Hey everyone, the biggest investment opportunity in years just hit metals, and here's why. What I'm about to share with you today represents one of the most significant shifts in US industrial policy that we've seen in decades. The metals market have been on fire for months, but based on what I'm seeing, this is just the beginning. A new strategic initiative by the federal government is triggering what could be a fundamental restructuring of how America approaches critical minerals and manufacturing. Today, I'm going to show you what's happening, why it matters, and help you understand the broader implications for the industrial metals sector with a focus on how one of America's largest mining companies fits into this evolving picture. This isn't just another story about mining stocks. This is different. This is urgent. And by the end of this video, you're going to understand exactly why this matters and where the smart money is rotating right now to protect itself and profit from what's coming. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. And if you want access to my best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily recordings on market analysis that cover any questions you ask in the community, you can try my Discord, the Stocks Community, for just $25 for 7 days at stockscommunity.com. And if you're looking for a free resource, head over to free.stockscommunity.com, where you'll be able to sign up for my free newsletter and get market updates that I can't share here on YouTube due to the sensitive nature of the content, some of which involves government figures and their stock portfolios that YouTube can sometimes restrict on its platform. The link is in the description below. As always, this is not financial advice. Do your own research. Now let's get into it. Let me start with what's happened this week that changes everything. On Monday afternoon, the US fundamentally changed its approach to the global commodities game. Look, every phone you touch, every car you drive, every data center, factory, and power grid in this country depends on one thing most people never think about, and that's metal. The US government finally acknowledged that reality in a very concrete way. What they announced inside the Oval Office may end up being one of the most important industrial policy decisions of our lifetime. This is one of those moments that doesn't feel historic in real time, but years from now, we'll look back and recognize the significance. The US just signaled a once-in-a-generation shift in industrial policy, not with a PR or some think tank proposal, but with a live announcement featuring cabinet officials, lawmakers, and some of the most powerful people in mining and manufacturing, all laying the groundwork for something that will reshape global supply chains for decades. Trump unveiled a brand new strategic initiative to build a $12 billion US critical mineral stockpile. The program's officially branded Project Volt. Now, let me put that in perspective for you. The entire global rare earth metals market was valued at roughly $4.13 billion in 2025, so 12 billion investment is absolutely massive. This can reshape supply chains, secure massive reserves. It's the first ever program like this designed not for weapons, but specifically for industrial materials. The mission is straightforward: protect American manufacturing from supply shocks and permanently reduce reliance on China for essential materials. Now, I know what some of you might be thinking. Politicians throw money at problems all the time and assume that solves everything, but this time there are some key differences we need to understand. This is not hypothetical. It's real money, real policy, real execution with serious private sector involvement. And if you want to know who's taking this seriously, just watch the body language of billionaire mining entrepreneur Robert Friedland in the Oval Office. He looks genuinely excited, and that's significant because he's someone who has a 10-acre oceanfront estate, 2 Beverly Hills mansions, a luxury flat in Singapore, a $50 million Gulfstream jet. He doesn't get excited easily. He's been around the block. He's lived through numerous commodity cycles, booms, busts, countless federal policy shifts. But what he saw Monday was something different. His words in that meeting capture the gravity of the moment. He said, "Thank you so much for what you've achieved. Everything we touched, we either grew it agriculturally," and he felt the farmers, or we mined it. All the cameras you see in front of you, they were mined. Every time you pick up a cell phone, it was mined. You cannot reindustrialize this country without metal. You can't rebuild Detroit without metal. You can't build AI data centers without metal. You can't manufacture electric vehicles without metal. And then came the key line: on behalf of every miner I know, they're elated at the breakthroughs that have been achieved here. This doesn't sound like fake flattery. This is recognition that the US government has finally acknowledged a reality that the mining industry has been trying to communicate for years. There's a global metal shortage coming, and the US is woefully unprepared for it. Let me break down the structure of Project Volt because this is where we can see the seriousness of the initiative. This is not a stimulus check, it's not some short term subsidy that disappears in a year or two. $10 billion will come from long dated loans via the US Export Import Bank, structured over approximately 15 years. Another $2 billion will come from the private sector, and look who's involved in that private sector commitment. We're talking about automakers, aerospace giants, technology leaders, companies like General Motors, Boeing, Google. These companies are not donating money to build goodwill, they're securing supply. That's what this is about. These are some of the most sophisticated corporations in the world. And they're putting real money into this initiative because they understand something critical. Without secure access to these materials, their entire business models are at risk. So, what minerals are we talking about? Project Volt isn't about stockpiling everything, it's focused on the most crucial minerals that matter most. The materials that sit at the heart of modern civilization. We're talking about rare earth elements used in permanent magnets, battery metals like lithium, nickel, and cobalt, specialized materials critical to semiconductors, electric vehicles, renewable energy systems, and advanced manufacturing. These are not optional inputs. There are no easy substitutes for most of these materials. Supply disruptions don't just cause inconvenience, they shut factories down completely. We learned this lesson the hard way in 2020 and 2021 when chip shortages hit automobile manufacturers. That shortage caused 9.5 million vehicles to go unbuilt. Laptops, TVs, gaming consoles couldn't be produced. Assembly lines sat idle. Billions of dollars in economic value simply evaporated because of a shortage in one critical material category. Project Volt is fundamentally about supply chain resilience. For decades, the US has outsourced the upstream side of its economy: mining, processing, refining. China took a very different approach. They invested heavily and systematically over decades. And today, China dominates large portions of the critical materials value chain. This didn't happen by accident. Control over critical materials is control over manufacturing, and control over manufacturing is economic and geopolitical power. Project Volt is America's answer to that reality. By holding physical inventory and by guaranteeing purchase agreements with domestic and allied producers, the US reduces its exposure to export bans, trade retaliation, and geopolitical coercion. Officials have been very clear about the comparison they're making. Project Volt is being described as the strategic petroleum reserve for manufacturing. The SPR wasn't created to trade oil for profit, it was created for energy security. Project Volt does the same thing, but for the materials that power electric vehicles, semiconductor chips, aircraft manufacturing, and the modern electrical grid. Now, here's where this gets really interesting from a structural standpoint. By acting as a buyer of last resort, Project Volt provides something that's been missing in the critical mineral sector, and that's consistent demand, price stability, and financing confidence. What we're witnessing is a structural shift in US industrial policy. For the first time in generations, the US government is saying explicitly that these minerals are not just commodities to be traded on open markets, they're strategic assets that require government involvement to secure. Mining projects that were previously considered too risky because of uncertain demand or price volatility now have a sovereign backstop. That means the government is effectively guaranteeing that if you bring a mine online producing critical minerals, there will be a buyer for your output. That changes everything for project finance. It makes it dramatically easier to secure loans, attract investors, and justify the massive upfront capital expenditure required to open a new mine. Now, let's talk about copper specifically, because copper is in many ways the foundation of everything we're talking about. And understanding how major producers navigate this landscape will help illustrate both the opportunities and complexities of this entire initiative. Copper is the most widely used industrial metal after iron and aluminum. It's essentially for electrical wiring, motors, telecom communications, and it's absolutely critical for the AI revolution that everyone's talking about. Every data center that gets built to train AI models requires massive amounts of copper for power distribution and cooling systems. Every electric vehicle requires 3 to 4 times as much copper as a traditional internal combustion vehicle. The electrical grid itself, as we electrify more of the economy, requires exponentially more copper. There's a reason people call copper Dr. Copper. It's considered a bellwether for global economic health because when economies are growing and industrializing, copper demand surges. But we're entering a period where copper demand is going to surge regardless of normal economic cycles, purely because of electrification and the AI build-out. In the US, the largest domestic copper producer is Freeport-McMoRan, ticker FCX. The company operates major copper mines in Arizona, including Morenci and Baghdad, and the Chino mine in New Mexico. They also have significant international operations in places like Indonesia and South America. Freeport is one of the world's largest publicly traded copper producers, and they also produce significant amounts of gold and molybdenum as byproducts. When we think about Project Volt, it will actually function this way in practice. FCX provides perhaps the clearest case study of both the opportunities and the complications. And here's why this gets interesting. For major metals like copper that are produced in enormous quantities, they're well-capitalized companies help them. The government doesn't need to build warehouses and stockpile physical inventory the way you might imagine. That would be incredibly inefficient. Instead, what makes sense is to engage directly with major producers and reserve part of their ongoing production. So the government would approach a company like Freeport and say, you will reserve X thousand tons of copper from your production. We'll pay for it. We'll pay for the storage costs. And when we need it delivered to a specific location, you ship it on our behalf. That's how you create a functional stockpile for major metals without the logistical nightmare of actually taking possession of everything and storing it in government facilities. You don't take physical delivery of material that's just going to sit in a warehouse aging. And yes, metals do age. Copper oxidizes, its surface properties change. You want fresh material that goes directly from production to end use with minimal time in storage. So when the government needs copper delivered to a manufacturer, Freeport doesn't look for old inventory. They say the next 1,000 tons coming out of production are yours, fresh, ready to go, meeting exact specification. That's a smart way to do it for copper, aluminum, iron, steel, the major metals that have high daily production volumes and rapid turnover. Now, here's where Freeport's situation gets more complex. Freeport-McMoRan is not just a copper company, although copper represents the vast majority of their revenue. They also produce molybdenum, which is used in specialized steel alloys and has its own strategic importance, and their operations span multiple countries with very different political and regulatory environments. Their largest mine by production is Grasberg in Indonesia, which is one of the largest copper and gold mines in the world. But Indonesia has been increasingly assertive about wanting more of the value chain to remain in country. This creates a complexity for a company like Freeport when you're thinking about strategic reserves for the US. How much of Freeport's production can realistically be committed to a US strategic stockpile when a significant portion of the production comes from foreign operations that are subject to foreign government policies? This is not a trivial question. It gets to the heart of what domestic production actually means in a globalized mining industry. Freeport's U.S. operations, primarily in Arizona and New Mexico, produce several 100,000 tons of copper per year, but that's only a portion of their total global production. So when we talk about the government reserving production from Freeport, we're really talking about production from specific mines on U.S. soil, not the company's total output. This matters because it limits the scale of what can be committed to a strategic reserve from any single company. Now let's layer on another complexity. Freeport, like all major mining companies, sells most of its production under long-term contracts to industrial customers. These are smelters, refiners, wire manufacturers, and other downstream processors who depend on reliable supply. If the government comes in and says, we want to reserve 20% of your U.S. production for the strategic stockpile, that potentially disrupts existing contract commitments. How do you manage that transition? This is where expertise becomes critical. You need people who understand not just mining and metallurgy, but also the commercial dynamics of how these markets actually function. Copper isn't sold at a single price point. There are different grades, different delivery terms, different contract structures. The government needs people who understand these nuances, or they'll end up overpaying, getting the wrong specifications, or creating market distortions that have unintended consequences. There's also the question of price volatility and market impact. Copper prices are set globally on exchanges like the London Metal Exchange and COMEX in New York. If the US government announces it's going to purchase massive quantities of copper for a strategic reserve, that announcement itself will move the market. Prices will spike. Speculators will front run the purchasers, and the government could end up paying significantly more than necessary. This is exactly what happened historically when governments announced large-scale purchases of commodities without proper market management. So there's a real question of execution strategy here. How do you acquire the volumes you need without creating a price spike that makes the entire program more expensive? One approach would be to structure long-term purchase agreements that lock in prices or use formula pricing tied to averages rather than spot prices. Another approach would be to spread purchases over time to avoid market impact, but both of these approaches require sophisticated commodity market expertise. Now, let's think about this from Freeport's perspective as a company. On one hand, having the US government as a customer with long-term purchase commitments is phenomenal for business stability. It de-risks your production, it provides guaranteed demand, even if industrial demand softens. On the other hand, there are complications. If you're committing production to a government stockpile, you might be accepting prices that are lower than you could get on the open market during periods of high demand. You're also potentially limiting your flexibility to respond to market conditions. And there's always political risk when you're deeply entangled with government programs. Administrations change, policies change, mining's a long-term business. Mines operate for decades. You need stability and predictability. Government programs don't always provide that. There's another dimension here that's worth considering, and that's the environmental and permitting side. Freeport has ongoing challenges with permitting for mine expansions in the US. Environmental reviews for mining projects take years, sometimes decades. A project vault's going to drive increased demand for domestic copper production, and if Freeport is going to be a major supplier, then the government needs to be thinking about how to streamline permitting and reduce regulatory barriers. You can't have a strategic minerals policy that says we need more domestic production while simultaneously make it nearly impossible to actually expand production through regulatory obstacles. This is a tension that hasn't been resolved. Now, let's talk about the technical side of what Freeport actually produces, because this matters for a stockpile program. Copper comes out of a mine as ore. That ore gets processed into concentrate, which is typically around 25 to 30% copper. That concentrate then goes to a smelter, which produces blister copper or anode copper, and then that goes to a refinery, which produces cathode copper that's 99.99% pure. This is the form that's actually used by manufacturers. So when the government says they want to stockpile copper, which form are they stockpiling? Are they stockpiling concentrate? That would require them to have access to smelting and refining capacity when they actually need to use it. Are they stockpiling cathodes? That's easier to store and to use, but it ties up more capital because you're buying the refined product. Freeport operates across this value chain. They mine ore, they produce concentrate, and they have some smelting and refining capacity, though they also sell concentrate to third-party processors. So the question of what form gets stockpiled has real implications for how Freeport and companies like them participate in the program. Here's another wrinkle. Copper demand is global, and prices are set globally. If the US creates a stockpile that takes significant supply off the market, even temporarily, that affects global prices. Higher global prices benefit Freeport because they get higher prices for the production they're not selling to the stockpile. But higher prices also make manufacturing more expensive in the US, which works against the reindustrialization goal. This is the kind of second and third order effect that makes commodity policy complicated. There's also the question of what happens to the stockpile over time. Let's say the government successfully builds up a reserve of copper, with some of that coming from production reserved at Freeport's US mines. How long do they hold it? What triggers a release? If there's a supply disruption and prices spike, does the government release copper from the reserve to stabilize prices? If they do, that's good for consumers and manufacturers, but it's bad for producers like Freeport who would benefit from higher prices. This is exactly the kind of tension that is played out with the Strategic Petroleum Reserve, where decisions about when to release oil become politicized. Let me try to synthesize what all this means. Freeport-McMoRan, as the largest U.S. copper producer, is in a unique position relative to Project Vault. They have existing production capacity on U.S. soil. They have decades of operational experience. They understand copper markets as well as anyone. All that makes them a natural participant in any government program to secure domestic copper supply. However, they also face significant constraints and complications. Their U.S. production is limited relative to their global production. They have existing contractual commitments. They operate in a capital-intensive industry with long lead times for expansion. They face regulatory and environmental hurdles. They're subject to global market prices that they don't control, and they have to balance their obligations to shareholders with any commitments they make to government programs. From a pure business perspective, having government purchase commitments is attractive because it de-risks production and provides steady demand, but it also comes with strings attached, potential price controls, political oversight, and limitations on operational flexibility. The government's challenge is to structure this program in a way that actually achieves the policy goal of supply security without creating market distortions, without overpaying, and without building dependence on a system that might not be sustainable long term. This requires expertise that, frankly, I'm not sure currently exists within government agencies. The Defense Logistics Agency has experience buying military supplies, but that's different from managing strategic reserves of industrial commodities. There's a real risk that this program, despite good intentions and serious financial commitment, could stumble in execution simply because the government doesn't have the institutional expertise to do this well. That's not a reason not to try, but it is a reason to be realistic about the challenges ahead. For anyone following the copper market or interested in understanding how major mining companies navigate these policy shifts, Project Vault represents a significant new variable. It could provide downside price support if the government commits to being a buyer during market downturns. It could provide demand stability that makes mine expansions more economically viable. But it could also create complications, regulatory overhead, political interference, and market distortions. The net effect will depend entirely on how the program is structured and executed. And that's really the key takeaway here. Policy announcements are easy, execution is hard. $12 billion sounds like a lot of money, and it is, but if it's not deployed intelligently, with proper expertise and realistic expectations, it could easily be wasted without achieving the strategic goals. Now let me zoom back out to the bigger picture. Copper is just one metal, although it's a critical one. Project Vault is supposed to address a whole portfolio of critical minerals. Each of these minerals has its own supply chain, its own market structure, its own set of producers, and its own complications. What we've just walked through with Freeport and copper illustrates the complexity of getting this right for even one well-understood major metal with existing domestic production. Now imagine trying to do this for rare earth elements, which have much more complex processing requirements and essentially no domestic supply chain. Or for lithium, which is produced using completely different methods. Or for cobalt, which is primarily a byproduct of nickel and copper mining. Each of these materials represents unique challenges, and solving all of them simultaneously is an extraordinarily ambitious undertaking. Having said all that, I think it's important to recognize that doing something is better than doing nothing. The status quo, where the United States is almost completely dependent on foreign sources for critical minerals, is not sustainable. Even an imperfectly executed strategic reserve program is better than having no resilience at all. And there's value in the government finally taking this issue seriously at the highest levels, even if the implementation is messy. For companies operating in this space, this represents both opportunity and uncertainty. Opportunity because government backing for domestic mining could make U.S. operations more valuable and more politically supported. Uncertainty because government involvement in markets always creates unpredictability, and because the details of how this actually gets implemented will matter enormously. Now, I want to be very clear about something. Nothing I'm saying here is financial advice or recommendation to buy or sell any security. I'm not a financial advisor, and you should always do your own research and consult with qualified professionals before making investment decisions. What I am doing is helping you understand the structural changes happening in the sector and why they matter, using real-world examples to illustrate the complexities involved. Ticker FCX, though, that's the best stock idea I've got for you today, guys. And if you want access to the best trade of the day based off a combination of market experience and algorithmic screeners that I use, plus daily 15-minute recordings on market analysis, head over to stockscommunity.com. Try my Discord for just $25 for 7 days. Plus, if you want market updates I can't share on YouTube, sign up at free.stockscommunity.com. If you found this valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it. Because the rotation into copper is happening right now, and the people who understand what's going on are going to position correctly for the next phase of this market.